The S&P rebounded. Is this the rally that will get it back into a bullish run? I will go over this in the weekly review of the markets for week ending March 15th, 2019. This is Agustin Hernandez. Before we begin, the opinions voiced in this material are for general information only. All performance reference is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly. Technical analysis is the forecasting of future financial price movements based on the examination of past price movements and cannot predict the future. Technical charts referenced are subjective. No strategy can ensure success or protect against loss. International markets involve special risks such as currency fluctuation and political instability. These risks are often heightened for investments in emerging markets. International investing may not be suitable for all investors. Investing involves risk, including loss of principal. Sector investing will be subject to greater volatility than investing more broadly across many sectors and companies. On this week's agenda, the S&P had a strong week. Is this the rally that will get it back into a bullish pattern? What sector is leading the U.S. equity markets? What other global stock markets are getting bullish? Did this rally shake the strength of the 10-year U.S. government note? And finally, what does this mean? Last week, the S&P rebounded and had a strong week. It ended the week at a gain of 2.89%. Now let's look at the daily chart to see if there has been any changes to the structure of the price and moving average pattern. First, we do see that price was able to get back above its long-term moving average. Also, its 50-day moving average is still sloping up and is now within earshot of a positive crossover. But having said that, mission is not accomplished yet. These are positive, but for this to become a long-term bull rally, we need to get the 50-day moving average above a rising 200-day. Also, we need to break above the old highs of 2018, which is still about 4% above where the S&P price is as of Friday the 15th. Now, if we can focus on the MACD, our momentum indicator, we do see that the bars are orange, which is weakness. But these bars are getting smaller, and if the S&P can get into the green, that may be the momentum needed to get the S&P into a bullish pattern and possibly a bullish run. Let's see if the Fed week is a catalyst or a drag on this market. While we wait to see if and when the S&P gets into a bullish pattern, it is a good idea to find the leaders in U.S. equity markets. As I have previously demonstrated in these videos, the tech sector has shown strength. Looking at price, the infotech sector did suffer a pullback from its highs of early 2019. It currently is resting right on its 200-day line. Depends on the day of the week, it will be above or below it. But for now, it looks to be in rest mode before deciding which direction it wants to go. A good piece of news is that currently this index has its 50-day above its flat 200-day moving average. So despite the pullback, its moving average pattern has not changed. Now it does look like the 50 days begin to flatten out, but since this is a quicker moving average, it may just be a byproduct of the short-term drop in price. But we will need to get price back above its quicker moving average. In regards to momentum, it looks like this index is trying to get its MACD bars back into green. If we can get a positive momentum, this may be the push this sector needs to try and push to get above its old highs of 2019. Let's see if this resting pattern is for a new rally or just a pause before another drop. Now, within the tech sector, we have the software industry. Now, unlike the tech sector, the software industry rise has been more methodical. Like the S&P, it hit a low on the 24th of December then began its rise. In fact, what is positive about this group is that after every pullback, price gets back to the green and goes higher. Also, a great sign of strength is price is above both its rising 50 and 200-day moving averages. Looking below its MACD indicator, this group got back into the green after a short time of weakness. Positive momentum has the possibility to get this group even stronger. The software group seems to be the leader of a possible stock market bull run. As we wait to see if the US stock markets can get back into bullish patterns, are there other stock markets around the globe that are showing signs of possible long-term strength? The first of these is a frequent guest of these videos, the Brazilian Bovespa. Here we see a market in a bullish pattern. Price, after a short pullback, got back above its rising 50-day moving average. Also, its 200-day moving average is also rising. Last week, price did break above its old highs of 2019. All good signs of a market trying to get into a strong long-term bull run. Looking at its MACD momentum indicator, after a month of being in weakness, the bars finally turned green, and positive momentum got this index to its highs of 2019. Let's see how long this positive momentum can last. Below that chart, we have the Hong Kong Hang Seng. Just last week, this index got a positive crossover. Now, that does not guarantee a big bull rally, but it is a positive first step. What will be needed is to get the 200-day first to flatten out and then to begin to slope higher. The MACD is currently in weakness as the bars are orange, so any change in that to green would only be positive for this newly emerging bullish pattern. Now, with a strong week by the S&P and the rest of the U.S. stock market, what did that do to the 10-year U.S. note? Once again, this note has shown strength despite the recovery rally of the U.S. stock market. Last week, this index gained 0.20%. While not earth-shattering, keep in mind that this asset is not a high flyer. In fact, its government obligation is just short of its high of 2019. Momentum as of last Friday was in the green, which is positive for this asset. At what point can this note continue to defy the strength of the S&P? Will the failure last week to top its old highs be a peak before finally coming down? Or are bond traders seeing something in the market stock traders are not? What does this mean? The U.S. stock market bounce back last week was impressive, but as of now, we are still in a recovery mode. We are getting close to the S&P getting in a positive crossover in its moving averages, and we are only about 4% from the highs of 2018, but close only counts in horseshoes. It is a positive sign to see a sector like tech and in particular software leading, but it would be a better rally if we can get the other sectors participating. As I said in a video last week, we are getting close to an answer to this rally. Is it the birth of a melt up or is it a bull trap? For now, using my long-term indicators, we are not at a point to say we are in the clear for a new rally. There still needs to be more to be done to confirm this. It is good to see other country stock markets trying to get into strength. It looks like the Hang Seng is in the early stages. The Brazilian Bovespa is one of the few stock markets to have a rising 50 and 200-day moving average. That is a great sign of strength, while the rest of the global stock markets are recovering. Just like the U.S. stock markets are getting close to an answer of yay or nay, the fate of the U.S. 10-year note should come soon. Will its momentum stay positive and have a new high in price soon? Or will failure of breaking above its high last week be the peak before a gradual fall? We are close to those answers. Patience will be the key. Thank you for viewing my video. Please like and subscribe to my channel for future videos. Also follow me on Twitter at my handle HRSNYC.